Hello, in this video, we're focusing on the practical concepts that you can actually apply in the real business world. Hope you enjoy it. Let's get on with it. Welcome, everyone. Today, we're going to explore how to make smarter decisions when investing in real estate. Whether you're a first-time buyer or experienced investor, understanding the financial side of property investment is key to success. We'll break down the important concepts and strategies that can help you make informed choices, minimize risks, and maximize your returns. Let's get started by looking at what goes into financing real estate and how you can crack the code to smarter property investments. Real estate has always been seen as a strong way to build wealth, whether through residential rentals, commercial projects, land, or mixed-use developments. Investors are drawn to property because it offers steady income, growth potential, and a way to diversify their portfolios. What really makes the difference between successful investors and those who don't do as well isn't just the type of property chosen, but how well they understand real estate finance. This means effectively using capital, whether it's your own money or borrowed funds, to buy, develop, and grow property investments. It involves managing risks, structuring deals, using debt wisely, forecasting cash flow, and assessing returns. When done right, this approach can drive long-term wealth. When misunderstood, it can lead to financial strain and failed investments. This presentation will guide you through the key concepts of real estate finance, showing how they apply in real life, discussing pros and cons, and offering clear strategies to help you make smarter and more profitable property decisions. Most businesses have limited financial resources. So real estate finance is important because it lets companies control valuable properties without using all their own money. By using mortgages, loans, or partnerships, a business can buy a property worth millions with just a portion of the cost up front. This helps them keep cash available for their main operations, grow faster, and scale more efficiently. Beyond this, real estate can become a source of income, not just a cost. For example, a company might occupy part of a building and rent out the rest, or a developer might create a project that generates rental income and property value increases over time. Over the long term, owning real estate finance wisely means tenants effectively pay down the loan, the property appreciates in value, and equity grows quietly in the background. This can turn one investment into a larger portfolio without needing much more capital from the business. These benefits combined make capital efficiency the key advantage of real estate finance for businesses. Understanding how to evaluate an investment properly is crucial for effective real estate finance. One of the first things to consider is cash flow, which is the money you have left after paying all expenses like operating costs and debt. Positive cash flow means the investment is financially healthy. Next, return on investment, or ROI, helps you see how much profit you make relative to what you initially put in, usually aiming for 8 to 15% annually. The capitalization rate, or cap rate, is useful when comparing properties. It looks at your net operating income divided by the property value, with higher rates suggesting higher returns but also higher risk. Finally, the loan-to-value ratio, or LTV, tells you how much of the property's value is financed by debt, and banks typically prefer this to be below 75 to 80% for investments. Keeping these key metrics in mind helps investors make smarter, more informed financing decisions. When choosing the right financing strategy, it's important to match the loan type to the property and your goals. Traditional mortgages work well for residential small investment properties because they offer predictable payments and generally low interest rates, though they can be slow to process and have strict qualification rules. For larger or commercial properties like office buildings, retail spaces, or industrial units, commercial real estate loans are useful as they allow for bigger loans and more flexible terms, but they come with higher interest rates and require asset-based underwriting. Bridging loans serve short-term needs very effectively, especially if you want to act quickly on property acquisitions or renovations due to their fast approval, although their interest rates are high and repayments need to happen quickly. Joint ventures spread the financial risk among partners and increase capital availability, but they do require shared decision-making and can involve complex legal agreements. Private equity or angel investors bring capital and valuable expertise without adding debt. but this means giving up some ownership and needing to provide regular reports to the investors. Finally, refinancing can free up capital for new investments while keeping ownership of the property, though it depends heavily on current market conditions and your credit strength. Understanding these options helps you pick the best fit based on your property type, investment timeline, and financial capacity. A small business owner in Manchester faced rising rent costs, so they decided to buy their premises using a commercial mortgage. They purchased the building for £650,000, putting down £130,000 deposit and borrowing £520,000. Their monthly mortgage payments ended up lower than their previous rent, and they even converted some of the space into a rentable cafe, which brought in extra income. This move reduced their business costs, created a new revenue stream, and gave them an asset that is growing in value. Meanwhile, a first-time investor bought a duplex for £280,000 with a 75% loan-to-value mortgage, putting down £70,000. The rental income was £2,000 a month, while mortgage and other expenses totaled £1,400, creating positive cash flow. After 3 years, rising equity allowed the investor to refinance and free up £40,000, which they used to buy a second property, effectively building a portfolio from one initial investment. Lastly, a London developer teamed up with a private investor to fund a project they couldn't afford alone, a development of 4 luxury flats costing £1.5 million. The investor funded 80% of the cost in return for 40% of the profit. When the flats sold for £2.3 million, the project made £800,000 in profit, with £480,000 going to the developer. This partnership let the developer complete a major project while providing the investor with a strong return. These examples highlight how different strategies in real estate finance can help businesses, investors, and developers achieve their goals, reduce risks, and build wealth. Using leverage in real estate allows a small amount of capital to control much larger assets, which can significantly boost returns on investment. Real estate also offers predictable income through rental yields, providing a steady cash flow that many investors find appealing. Over time, property values tend to appreciate, contributing to long-term wealth growth. Additionally, investing in real estate helps diversify a portfolio, reducing exposure to the ups and downs of the stock market. There can also be tax advantages depending on the area, such as deductions on mortgage interest, depreciation, and operational costs, which can further improve overall financial benefits. Together, these advantages make real estate finance a powerful tool for building and protecting wealth. One of the main risks with real estate finance is taking on too much debt, which can become a serious problem if the economy slows down. Interest rates can also change unexpectedly, especially with variable rate loans, making payments less predictable. Unlike stocks or cash, property isn't very liquid, so selling quickly can be difficult. Managing real estate requires effort too. Dealing with tenants, repairs, and keeping up with regulations all take time and expertise. Finally, real estate markets go through cycles, meaning property values can sometimes stay flat or even drop during recessions, which can impact returns. These are important factors to keep in mind when considering real estate finance. Real estate finance goes beyond just getting a mortgage or borrowing money. It's a well-planned system that can turn a small investment into significant wealth over time. By learning how different financing options work, analyzing key investment numbers, managing risks, and using leverage smartly, both investors and businesses can access opportunities that might seem out of reach otherwise. Making smarter investment choices comes from really understanding the financial details, strategies, and tools at your disposal. If you follow the principles we've discussed, you'll be better equipped to navigate real estate finance successfully and build a more secure and lasting investment portfolio. If you found this video useful, there's plenty of more business and finance videos on the channel that you'll enjoy watching and get great practical value from. In the meantime, thanks for watching.